Awesome. Okay. Well, you're more than welcome to get started.
Okay, thanks a lot. Appreciate everybody joining on your lunch hour or whenever you end up watching this. I'm sure some of you will be seeing this at a different time. That's terrific. So my name is Todd Bailey. I'm happy to be presenting today on how you can sell your business. I'm president and owner of Transworld Business Advisors here in Wichita, Kansas. Transworld is a franchise business. I own the South Central Kansas territory. Transworld is the largest business brokerage franchise company in the world. We have almost 300 offices based in Florida, but we have offices nationwide and worldwide. So happy to be here along with Wichita State University and SBDC to make a presentation today on how do I sell my business. So glad you could all join. And again, we'll open some time at the end for any questions you might have. So let's get started. So what we're going to talk about today, a real brief, a little agenda here, if you will, is confidentiality. We'll talk about that multiple times because that's very, very important in this process. Valuation, how do we determine the value of your business, which is, again, a very important part of that process. Advertising and marketing. We're not going to talk about how you should advertise and market within your business. We're going to talk about advertising and marketing, the fact that your business is for sale. Offer, due diligence, and negotiation, lots of important pieces there that we'll cover. Deal structure, meaning how do you get paid? What does all that look like? What does the closing process look like? So once we get it all to the end of the line, what does that look like? And then this might sound a little bit backwards, but we're going to talk about pre-sale preparation at the end of the discussion today. And I think that works well because once you've seen everything else that goes into it, I think that that preparation process might make a little bit more sense. So let's just jump right in. Confidentiality, the most important part about confidentiality, I believe, is internal within your business. So we don't want employees and managers to get worried. We really don't want them to leave. We don't want morale to change. All those things lead to company performance changing, never for the better. So we want to make certain, as much as we possibly can, that we keep it confidential within the business. Now, a lot of business owners, by the time they get to the point of selling their business, they have employees that have been with them for 5, 10, 20, I've seen 30 plus years. And those owners know that those key people are the people that have allowed them to get to where they are today and in a great position to sell a great business. And so there's some emotion there, and there can be some guilt in keeping a secret, because these are the people that you probably haven't kept any secrets from for 20 years. And I understand where that comes from, but I use kind of an analogy to help people understand that, picture yourself pulling aside your key employee that's been there for 20 years and telling him or her, look, I want you to know I'm going to sell the company. I don't know when I'm going to sell it, and I don't know who I'm going to sell it to. And I don't know what's going to happen to it or to you after it's sold, but boy, I feel a lot better now that I've told you, right? That doesn't work well. That sends an employee home to their spouse. They get the resume out, they start looking for jobs, right? As opposed to, just kind of keep that emotion in check till you sell the business, and literally the day of or the day after closing, then you pull your key employees aside, you pull all your employees aside, and you tell them, I sold the business. You introduce them to the new owner. You tell them that the new owner knows everything about them. They know how important they are. They know how key they are to the success of the business. And the new owner is going to tell them, I know how important you are. I need you here. I need your help. And so that sends an employee home maybe with a little bit of worry, but not the kind of worry that makes them go get another job, right? So we really want to keep that confidential, because the last thing we need is our employee base to be negatively affected. Valuation. So we'll have a couple of slides on this. Of course, everybody wants to know, how much is your business worth? When you sell your car, how do you find out how much it's worth? You can go on places online. When you sell your home, you have ways. Well, how do we do it for a business, right? So the first thing we're going to do is a financial calculation of seller's discretionary earnings, or SDE. Now, SDE is not something you'll find in QuickBooks. It's not something you'll find in your accounting software of any kind, because it's not a recognized accounting term necessarily, but it's a very important number. And for a small business, we have to calculate the SDE, and that is going to come from multiple places. So I know some of you may or may not be more or less accounting savvy, but we're going to start with EBITDA, which is earnings before interest, taxes, depreciation, amortization. A lot of companies and a lot of accountants use this as a real strong base for understanding the cash flowing of the company. So that's earnings, so that's net income. And then we're going to add depreciation, amortization, and if you have income tax you've paid on your business, we're going to add that back. So that is what EBITDA is. Then we're also going to add back the owner's wage. What has the owner paid himself or herself through the business? We're also going to look at their direct benefits, and by direct benefits, we're going to mean things like contributions to a retirement account, contributions for owner's health insurance, things like that. Then we can also look at owner other benefits, and that's where sometimes it gets vague. So I know there's a lot of business owners out there watching this, and you know lots of business owners, right? So we all know lots of business owners, and that spectrum of how they expense things on their corporate tax returns is far and wide. So at one end of the spectrum, we have straight and narrow, absolutely no fluff in the business tax returns, in the expenses. And at the other end of that spectrum, we have those business owners, I think we all know, that expense everything through their business. And you kind of almost wonder how they sleep at night. You know, I mean, my God, all those things are going through your business. So we're going to look at those other benefits, and we're going to make some decisions on which of those we think we should factor in and which ones we should, okay, to determine that SDE. And we're going to do that for multiple years. At the bottom of this slide, you see where it says tax return versus P&L and front page. So the tax return, as you would imagine, is kind of the holy grail of official documents, right, for a company. So when a buyer gets to a point of lending or talking to SBA or talking to investors, the P&Ls are nice, but those are typically internally generated. The tax return is, again, that's the official document. So we really want to use the tax return. And when we say front page, on the front page of your tax return is where you see everything that goes into calculating the EBITDA. You also typically would see the owner wage, and you might see some of those direct benefits. When you have to go to back pages, that's when you see the other benefits, and that's when it starts to get a little bit dicey for lenders and for SBA. So when we talk about tax return front page, that's where the real significant numbers are. So we're gonna look at seller's discretionary earnings for multiple years, typically 3 full years prior, and then partial year, whatever we're in. So like today is August 18th. So if we were doing that for today, we would want to look at tax returns, if possible, for 2018, 19, and 20. Then we would also want to see your P&L through, if this is August, maybe you have it through Q2. So maybe you have it through the end of June. Okay, so we're going to do those calculations and determine what that SDE number is. And once we have the SDE number, that becomes our basis for determining the value of the business. So we can look at that in multiple ways. We can look at accepted multiples. So for different markets, different industries, different geographies, we will have different multiples. Maybe it's 1 times for some type of business, and for another business, it might be 10 times. Typically, we're looking in the 2 to 4 range for most small businesses, but that can have a lot of flexibility. We also might look at comparative sales. So when you sell your house, you look at what's sold recently around your neighborhood, and then you look at the current market and see what's currently for sale. We can do some of the same things with your business. So there's ways to find that information about companies that have sold recently. There's certainly ways to find out what's currently for sale, and we can do, just like when you sell a house, we can do comps. We can find out what that is. We can also test the market by actually getting the business out there on the market at a certain price and seeing what that reaction is, right? So one thing that's also important here is the confidentiality, right? We want to make sure that as we're doing this, we're not giving away the farm, right? We don't want people to know what we're doing. So again, we're going to take that SDE number. We're going to look at accepted multiples. We're going to look at comp sales. We're going to look at the current market. And that is how we're going to narrow down what we really think the business is worth. That's how you can figure out what your business is worth. And from there, you decide, do I want to sell it or not? Sometimes you find people that They find out they're not ready to sell because maybe they need more for debt service or for retirement, or maybe they just want more, or maybe it just doesn't feel like it's enough and they'll keep working for another 5 or 10 years. That's that point at which that decision is made, but that's how we do that valuation. Confidentiality, again, I told you we're going to talk about this more than one time. So we talked earlier about confidentiality as it relates internally to your staff. Externally, we want to talk about confidentiality with customers. Now, depending on the type of business, we're all customers of dozens, if not hundreds of businesses every day, right? So if you think about as a customer, what kind of business, if you found out that it was for sale, what kind of business would that bother you, right? Sometimes you don't care, right? Sometimes you don't even know who owns the business. It's just someplace where you go get products or services, and that's fine. But if it's something that's a real personal relationship, or if they have your private information, or if there's proprietary information involved and you find out that that business is for sale, a lot of times most people consider worst case scenario, even though it may not be worst case scenario. They don't know that. So we want to keep the fact that the business is for sale confidential from customers also, because we don't want our customers to leave. I mean, there's a lot of reasons they may leave, and we could talk about that for days and days, but it doesn't really matter. If the customers decide they want to leave because they know your business is for sale, then that's going to affect the performance of the business, and that's going to affect the price you can get and the sellability of the business. So unless there's real specific circumstances, we really want to keep that confidential from our customers as well as our employees. And also with our landlord, you see that it says temporary there. At some point in the process, we always have to bring the landlord in, if there is a landlord. If you own the property, that's not a consideration, but if you have a landlord, we have to bring them into the process, but we don't have to bring them in right at the beginning. We do want to keep it confidential from them for a while. And once we're ready to bring them into the process, hopefully you have a good enough relationship with your landlord that doesn't cause any problems. But in order for a buyer to secure a lease and all those things, we have to bring them into the process later. Advertising and marketing your business for sale. So you've decided to sell it. You know what price you're probably going to sell it at, or at least where you're going to start. So how do you get it out there? How do you let people know that it's for sale? So I'll ask a question. For all of you that are watching, when you left your house this morning and you drove to work, or you drove to wherever you're at, maybe you're watching this from the golf course, I don't know, wherever you went, how many signs in yards did you see that said this house is for sale? I know when I left my house, I probably saw 8. They're everywhere, right? And they all say sold on them, or they all say sale pending, right? So when you sell your house, you want the world to know. You want to find the buyers out there. So that's how that works, right? Or we all know it. How many of you have seen on any business in the last 2 years a sign that says this business is for sale? Now, I don't mean commercial real estate. We see those signs also with Insight and Wygant and a lot of those guys. So I don't mean the commercial real estate. I don't mean the building. I mean the actual business. My guess is that there's very few, if anybody, on this call that could say they've ever seen a sign that says this business is for sale. It happens once in a while. Yet we all know that these businesses are bought and sold all the time, all over the city. It happens. It's what I do. It's what other people do. It happens without brokers. We know it happens. We've all learned of it happening. So how does that happen? So there's a lot of ways we can get that out there. With personal networking, some people belong to the chamber, to WEBA, to other networking groups. They have their own network. They have their personal network. There's a lot of ways to do it. So there's that personal network, whether that's business or personal, you can use that network to get the word out. Internet and websites. There's lots of websites that exist purely to put buyers and sellers together. So you can list your business on those websites. You can also put advertisements on Facebook. You can put it on Craigslist. You can put it on YouTube. There's lots of places you can put it there. Associations. There's hundreds and hundreds, probably thousands of different trade associations or market associations, industry associations out there. Some of those associations will do a really nice job of helping you find buyers. Some of them even have pages on their websites where they're trying to help their members buy and sell their member businesses. So there's another way to do it right there. A targeted search. For certain types of businesses, you might have a list, short list, maybe it's a long list of companies or individuals that you feel might be great buyers for your business. Maybe you've got a distributor business and you know that there's a bigger distributor that has locations in Kansas City and Oklahoma City and Dallas. You're like, well, guess what? They need to add Wichita. So you can reach out to those companies. So it might be 2 or 3 companies within the region or within the city. It might be hundreds of companies across the country. Whatever it is, that's what it is. That's a targeted search. In that case, we would reach out directly to those potential buyers and tell them we've got a business for sale they might want to consider. You can use a broker. Brokers use all of these methods and others to help you find a buyer. In that process, again, that word confidential comes up. How do we maintain confidentiality in that process? That can be a challenge, but we always use non-disclosure agreements. We always use confidentiality agreements. We want to use those to every possible way to maintain that confidentiality before you provide any information to a buyer. One more time on confidentiality, right? So we talked about internal with our employees. We talked about external with customers. Now let's also talk about external with vendors and suppliers. Again, vendors and suppliers may very well do a worst case analysis or worst case scenario analysis in their mind if they find out that you're for sale. Even though you may have an absolutely rock solid business making tons of money and you're going to sell to a great buyer, people don't know that, right? So we want to make sure that we don't let them know anything ahead of time, because again, worst case scenario is what they're going to consider. So some of those vendors may think they're selling because they're going out of business. We got to change their payment terms. So you might be on net 60 payment terms, and they may send you a letter that says, oh, by the way, guess what? Now you're on COD. You got to pay when you get it, or you got to pay ahead of time. That can really have a negative effect on your business performance, your cash flow, lots of things. They might change your minimum orders. Your minimum order may change. You don't want that to happen. Lead times can change. So there's really very little good that comes from confidentiality being broken when we don't want it to be broken, right? So offer and due diligence and negotiation. So we've got a price, we've marketed the business, we've got some buyers lined up, and now we're getting into the process of figuring out which one of these buyers is going to be successful. So we've got several things that happen. So LOI, letter of intent versus contract. This gets a lot of discussion with buyers and sellers. And LOI typically is really just a letter that says, here's what we intend to do. We intend to give you an offer, a contract at this price and these terms, but it's non-binding. It's not a contract. It's not a sale document. It's really just it's just a promise to do something later. A contract is an actual contract, just like it says, right? That's where here's how much we're paying, here's who's buying, here's who's selling, here's exactly what we're buying, here's when we're going to close, things like that. So we get detailed terms. And those things, we want to have all the detailed terms of exactly what's being bought, when it's being bought, how it's being paid for, when it's being paid for. Is there a commitment from the seller for training and transition plan? Is there a commitment from the seller on a non-compete agreement so that the buyer knows that the seller's not going to turn around and start another business competing with them a week after they close? So we have very detailed terms. The cancellation clauses in the time frame, all of the contracts can be a little bit different, but in a general sense, let me give you a general sense of how that process works. Of when we submit as a buyer, gives you a contract or an offer, there's typically going to be a deposit at that time that's going to be held by an escrow company of some sort. It can be an attorney, it can be a title company, lots of ways to do that. There's typically going to be a due diligence period. Now, for most businesses, that's going to be 2 to 3 weeks. If it's a large, complicated, multi-location business, it might be longer, but there's going to be a very specific period of time assigned to due diligence. So we have to have an end date for due diligence. And typically during that due diligence period, the buyer can cancel out at any time for any reason. They don't have to give a reason. They can cancel anytime during due diligence, and they get their entire deposit back. They are still bound by all of the non-disclosure agreements. They're still bound by the confidentiality agreements that they've signed, but they can back out during due diligence at any time for any reason. If we get to the end of due diligence period, and again, that's 2 weeks, 3 weeks, something like that typically, if they have not canceled and they have not renegotiated, because they can try to renegotiate and then say, if we can't renegotiate, we'll cancel. So if they haven't canceled and haven't renegotiated, then that deal is in place. And that means after that date, if they want to cancel, then they can cancel, but they give up their deposit. That's normally how that process works. Okay, so the cancellation clause for due diligence means during due diligence they can cancel. There could be other cancellation clauses as well. There might be a financing cancellation clause, meaning if I can't get my financing at certain terms, then I can cancel and get my deposit back as a buyer. Okay, there's also a lot of times going to be a lease contingency, which means if they can't get the lease. So I mentioned previously a little while ago, I mentioned the landlord. So we have to bring the landlord at some point and make sure that we can get a lease. So there's where those cancellation clauses can be in there. If none of those cancellation clauses kick in, that contract has a closing date, an estimated closing date. Sometimes that may change, may bump out, typically doesn't bump up, but the sooner the better. It might change because of financing. It might change because of licensing. You know, there's a lot of reasons it could change. But normally when we see these deals from time of an offer till time of closing, if it includes bank financing, we're typically looking at a minimum of 60 days, sometimes 90. If we have and we'll talk about these different types of deals a little bit later, but if we have a smaller business that's an all cash deal, then we can close a lot quicker. But we definitely want to have, again, we want to have a contract with detailed terms, detailed clauses, and a specific estimated closing date. Deal structure. So how do you get paid, right? Every seller wants all cash at closing. And sometimes that happens. And typically that's going to be a smaller company that might be bought up by a larger company that can frankly just write the check for it. And when we can do that, that's great. Most of the time that doesn't happen. So most of the time small businesses are bought with SBA guaranteed bank financing. So I'm assuming most of you are familiar with SBA, but real quick, SBA, Small Business Administration, federal government office. SBA does not lend money. That's a misconception a lot of people have. SBA does not lend money. SBA guarantees loans that your normal banks make. They guarantee 75 to 80% of a loan that a bank will make. That lets the bank make the loan to you. So most small business purchases include bank financing with SBA guarantees. And a lot of times that requires seller financing. Not every time. No seller wants to do this. We all know it. But sometimes the seller needs to be able to provide, typical amount is 10%. It can be anywhere from 0% in a cash deal to a higher number if needed. But typically we're looking at seller financing of 10%. And we also typically see that seller financing being on a 1 or 2 year standby required by SBA and required by the lender, because SBA, the lender, wants to make sure that that buyer is going to pay their bills for a couple of years before they add on yet another loan. So the seller financing is never a great part of the deal, but it's usually not a huge part either, usually around 10%. So, and when we do that, we also want to make sure that that buyer doesn't have other assets that they could borrow against. So, and then I also put on here earnout. Sometimes we see an earnout, which is another form of seller financing. So the first one I mentioned was more of a seller note. It's a loan. Here's how much the payment is. Here's the date it starts. Here's the date it ends. That's what a seller note is. An earnout is more related to the business performance. So in an earnout situation, we might see a situation where the buyer is going to pay the seller 5% of sales every quarter for 5 years. That's just an example, but it could be for 3 years, it could be for 10 years, it could be 10%. Maybe there's a cap on it, maybe there's not. So that's what an earnout is. So when we get into deal structure, that's when we start seeing lots of creativity, and creativity can be good because it can make a win-win situation for everybody. But you know, again, everybody wants the all cash deal, and sometimes that happens, but usually it doesn't. That's the reality. And then we can find as much creativity as possible in finding a deal structure between bank financing, SBA financing, seller note, earnout, things like that, to try and make sure we get the deal done. Closing. So we don't want to have any surprises at closing. If everybody's done their jobs the right way, there won't be any surprises. We're going to use a closing agent. That can be at a title company, that can be an attorney. There's a lot of ways to do that. We want to make sure we use an agent, so that the biggest reason we want to use an agent is so that the funds are transferred accordingly. So what we really don't want to have a situation of a nice big business and you're the seller. Your life's work is coming to fruition. You've got this nice check. It's a great deal. You're really excited to get into retirement. And then you don't want to roll into a closing and have somebody give you a personal check with lots of zeros on it. That can be quite nerve-wracking, and it's just not the right way to do things. So part of the reason we want to use a closing agent so that we have guaranteed funds. So just like when you buy or sell a house, you don't do that just between you and the other person. You do that through an agent. And that's the same reason we want to do that with a closing agent. We want to make sure we do things official and everything is clear and guaranteed. And then right after closing, like I mentioned before, right after closing, literally that same day, if possible, if not the next morning, company meeting, bring all the staff together. We have to make this announcement because as soon as it's closed, you're not the owner anymore. They are, and they need to take over. And normally we're going to see some level of a training period, right? A transition period, anywhere from a week to a couple of months. That really obviously just depends on the type of business and how experienced the buyer is. But that's where we want to make that announcement to the staff that we've sold the business. Here's the new owners. They're excited to get started and they're excited to get you guys involved. So now let's go back to pre-sale preparation. So you've kind of seen what all that looks like, and that was obviously kind of a quick run through, kind of a high level of the selling process. So what do you need to do ahead of time? What do we have to have ready in order to make all that successful? And by far, the biggest thing by far is clean books. And by clean books, we mean P&Ls and tax returns that are accurate. Obviously, tax returns those are a historical document, if you want to call it that. So we want to make sure that everything that's in the tax return is correct. And then as we do P&Ls, we want to make sure that those are correct. But what can you start thinking of when I say how far back? I mentioned earlier that typically buyers, lenders, SBA, they're going to want to see the previous 3 full years of tax returns plus whatever you have for the current year. So if this was happening in January, they're just going to want to see the previous year's tax returns. Now, maybe you don't have that tax return for the previous year because it just ended. That's fine. We use a P&L, but we want 3 full years plus the partial year that we're in. And what should you start thinking about 3 years ahead of time? If you have that luxury, right? If you're sitting here on this webinar today because you think I'm going to be ready to sell in 3 to 5 years, what do I need to do now? Most of that other stuff is nice information I gave you, but it's not anything you're doing with today. But what should you do? What should you do today if you want to sell in 3 to 5 years? And what I mentioned earlier about those different owner benefits, that's where you really want to start cleaning things up. So for example, if you have typically taken your family on a week vacation to Florida and it cost you $10,000 and you booked that through your business as business travel because there was a conference in Florida that you never went to, you just went to the beach, fine, you do that, okay. But just remember that when SBA or a lender or an accountant or an attorney or a smart buyer is looking at that, they're not going to count that as, they're not likely to count that as owner benefit. They're likely to count that as, you said this was business travel on the tax return, that's business travel on the tax return. So those kinds of things you might start to think about maybe easing off of that so that your tax return really does show, again, that back to that front page of the tax return, so that it really does show all your legitimate profitability in that business on the front page of your tax return. So that $10,000 of travel for the last 5 or 6 years, for the next 2 or 3 years, maybe that needs to still come out of your pocket, but that needs to go back onto the books as income, net income, right? So again, 3 full years plus the current year. Once you get to the point where you're really going to list the business, curb appeal is important. Kind of depends on the type of business. If you're a retail business, it's got to look nice, right? It just has to. If you're a auto repair facility, clean it up, make it look pretty. Do something with your waiting room, make sure it all looks good, right? If you're a service business, if you're a home cleaning business and you don't really have an office, that's fine, but you probably have someplace where you park your trucks or whatever. Just make sure you clean it up, because there is going to be a point in time when a buyer is going to want to see that. They're going to want to see your office. They're going to want to see the store. If you're a restaurant, they're gonna come eat there. They know that's gonna happen. They're gonna come eat there 10 times or more. So you've got to make sure you've got that in mind. Correct staff and structure. If you have the ability to make sure that your staff is the right size. So let's say maybe for several years you've been carrying some extra people that you keep them because you want to keep them, but maybe they wouldn't be around if you weren't around. Well, maybe that's the time to start making some of those tough decisions. The last thing we want to do the last thing you want to do is talk to a potential buyer about the staff and then say, yeah, but this guy is, he's kind of been skating along for a while, and this lady, she's not doing so well. We don't need that situation. So this is the right time to right size your staff. And your advisory team is, in your pre-prep, that's when you want to set up your advisory team. Do you have a CPA you work with? If they only do your taxes every year, then talk to them about their experience with helping their clients sell a business. It's not the same thing. Selling a business is not the same as doing taxes. I help people sell businesses, but I don't do taxes, and vice versa. If you don't have a corporate attorney, you need to find a corporate attorney that might, even if you're only going to use them for a few hours to review documents, you still need to get that team in place. If you have a financial advisor, you probably want to get them on board to tell them what you're thinking about, to make sure they can give you some advice, maybe on tax mitigation strategies. I don't know. And maybe you bring a broker in also. That's always up to you. But those are the things you want to do to prepare multiple years ahead of time or the day before. Whatever it is, as much preparation as you can do. And the more preparation, I think we all know, the more preparation, the better, right? That's really all I have. Went way less than an hour, so that's good. At this point, I suppose I would open that up for any questions you all might have. Michaela, are you there? Do we have any questions?
Oh, yep, it looks like one just popped through the Q&A. Let's read it. We have someone ask, what are typical deposit percentages?
Yeah, great answer. Great question. I'm sorry. So normally we want to see at least, it kind of depends on the size of the deal. We want to see 10% at a minimum. We want to see 10% at a minimum. But if it's a really large deal, sometimes we won't see 10%. It also is going to kind of depend on the finances of the buyer. So keep in mind, sometimes these buyers are buying a business with only 10% down, and that might be all they have. So we just have to kind of keep in mind, it has to be negotiated sometimes, but we always want to get a deposit. What is the calculation formula for SDE? Maybe I missed it. So I know that we can send the presentation out to you at any time, but the calculation of the SDE, we're going to take EBITDA, if you're familiar with that, EBITDA, EBITDA, so earnings before interest, taxes, depreciation, amortization. We're going to add the owner's salary. We're going to add the owner's health insurance if they contribute to their own health insurance, not to the employees or the rest of the company. We're going to add any contributions to any retirement accounts, 401ks, profit sharing, whatever. And then we can add, sometimes we can add some of the other things, like I mentioned in my example about the $10,000 vacation every year. We can add that in. We just have to be aware that a savvy buyer or a savvy banker, SBA examiner is going to find that. Maybe, they might squawk about that a little bit, but typically SDE is EBITDA plus owner's wage plus owner's health insurance benefits plus owner's retirement benefits.
Sorry, we have another one from Richard. He asked, what is a typical cost for going with a broker to sell the business?
Typical cost for brokers, it's always going to be a commission, which you might expect, and it's going to somewhat depend on the size of the listing. So typically what you will see is a 10% commission. If you get below $100,000 business, you might see more of a flat rate than a percentage. And as you get up over, when you start getting up close to $1 million, definitely over $1 million is when you'll start to see that that commission will start to hit a sliding scale that will start lowering that effective commission. The 2 to 4 times multiple, I'm just going to read this one. Where does the 2 times to 4 times multiple come through in valuation? Is it added to SDE or is it 2 to 4 times SDE? So it's 2 to 4 times SDE. So just for an easy example, if we look at the last few years of SDE and it's averaging right around $100,000 per year, then we're gonna say that business from a multiple standpoint is going to be worth $200,000 to $400,000. And then I would add to that also that how would we decide if it's 200, 300, 400? What is that? If that's the range, what is the right number? Then we're going to also, as I mentioned, we might look at some comps. We might see what's for sale out there, but we also will look at that specific business and ask ourselves, what's good about this business? What's bad about this business, right? So if we came up with that $100,000 of SDE, and that was based on every year for the last 3 years, it was increasing a little bit, then we're gonna go higher in that range. If we see that the revenues every year are going down, then we're gonna have to go down in that range. If we have some proprietary software that nobody else has, then we're gonna go higher in that range. If we're in a location if we're a retail location in an area of town that has street construction planned for the next 3 years, then we have to go lower. So we just want to look at all those other pieces that are not specific financial pieces. We want to look at all those other peripheral pieces of the business to see where in that range maybe this is supposed to be.
Okay, it looks like we have one more. When selling a retail business, does the cost of inventory on hand get added to the valuation?
Now, that's a great question, and that comes up a lot. The inventory is typically included in the price, as is so let's talk about a retail business. The inventory is included in the price. In a manufacturing business, the equipment is included in the price, and the rationale to that is without the inventory, the retail business can't achieve those results, and without the equipment, a manufacturing company can't achieve those results. Now, with that said, there are times where the cash flow multiple of the company maybe does not exceed the inventory value of the company or the equipment value of the company. So again, an example would be if we have $100,000 of SDE and we choose a 3 times multiple, which gives us a price of $300,000 for the business, but you have $400,000 of inventory on hand. Well, the inventory is worth more than the cash flow calculation, right? So in that case, we're going to value the company at the inventory value of the business. Same thing for a manufacturing company with their equipment. If we have the same calculation, the manufacturing company is worth $300,000 based on the cash flow multiple, but they have $500,000 current value of equipment. Well, the equipment is worth more than the business is on the cash flow calculation. So we're going to use that higher number for the business. Any other questions out there? Okay. Well, I think that does it for me. Michaela, was there anything else?
Nope, I don't have anything else.
Okay. Well, thanks everybody. I appreciate it. If you want a copy of that presentation, I know Marsha or Mindy or Michaela can get that to you. Appreciate your time today. Thanks a lot.
Thank you, everyone. Have a great rest of your day. Happy Wednesday.
All right. Thanks, guys. I appreciate your help today.